Mallinson. I'm a partner at King & Wood Mallisons in Melbourne. Though today I'm in a very soggy northern Tasmanian Midlands. I was reflecting, discussing with some of our panelists before the call. The first time I took out a term deposit, and I think the interest rate on that was a healthy 14% or more. How the world has changed over the last 30 years. Now we are contemplating the possibility of negative rates of interest with all the complexities and difficulties that that concept involves. Central banks have been active in asking banks in particular to make preparations for negative rates. It was a most emphatic letter issued by the Reserve Bank of New Zealand in the first half of last year. And on this side of the Tasman, the APRA, while it has not produced a similar letter, has been inquiring of banks as to their readiness to implement such a policy. As I said, the complexities of this are significant, and to guide us through them, we've assembled a panel today to bring perspectives both from an economic and a commercial and a legal and documentation perspective. A note on procedure: our panel will talk, each of our 4 members, for about 10 or so minutes, and at the end of that session, we would be happy to take questions. There is a Q&A function on the bottom of your Zoom screen, and you can type in your questions, and then if it is possible to indicate a particular panelist for whom the question is intended, that would help us in answering them at the end. But without more ado, let me introduce our panel. First of all, Sharon Zollner is the Chief Economist at ANZ in New Zealand, has been in that position for a number of years, and before then she had a distinguished career in central banking with the Reserve Bank of New Zealand and also with the Central Bank of Norway. Thijs Arten joins us from Hong Kong, and he is the Chief Financial Officer and Chief Risk Officer at APG Asset Management in Hong Kong, and specialises in pension fund investments. And Thijs is also on the board of ISDA. Peter Owls is a partner at Buddle Finlay in Auckland. Has practiced for a number of decades, I think, Peter, in banking finance and with particular emphasis on structured finance and project infrastructure work. And last but by no means least, probably well known to this audience, David Love, who's the General Counsel and International Advisor at the Australian Financial Markets Association, the leading industry association for Australia's financial capital and derivative markets. With those introductions, I think we'll hand first of all to Sharon to give us an economist's perspective on negative rates. Sharon.
Thanks, Ian. Yes, so negative rates were all the rage last year. We were all predicting them in New Zealand, at least, less so in Australia, where the central bank governor doesn't sound so wildly keen on them. But then, of course, the economies bounced back quite a lot, and the housing markets in both New Zealand and now Australia as well have gone pretty ballistic. But I don't think that means that we wasted our time in preparing ourselves for the possibility of negative rates, because it absolutely still is a possibility, which I say with some regret, because I think they are a very risky idea indeed. But there's a couple of things that could bring them about. One is that obviously global financial markets have been boosted enormously by a very long period of very low interest rates, which have boosted asset prices in many cases well beyond what fundamentals would suggest is warranted, whether you're looking at price to earnings ratios for equities or house prices relative to incomes or Bitcoin relative to anything you can think of. There are certainly some pretty questionable valuations out there. So is certainly a possibility given how much debt there is in the world and the mispricing of risk that's been going on for such a long time, that we could see something untoward in global financial markets, in which case we'd probably see more of the hair of the dog policy making that we saw after the global financial crisis, which is if you've made the financial system unstable by having interest rates too low for too long, well, then let's cut them even lower. So in that regard, a negative interest rate is still possible. But also here in New Zealand, the government has swung a sledgehammer yesterday at the housing market with a range of measures, but the most potent was removing interest rate deductibility from housing investments. So for highly leveraged investors, that is an absolute game changer. For people who have maybe one investment property that they've held for a long time and paid down a lot of the debt, it's probably neither here nor there. But the fact is that the marginal buyer, the one bidding the most at auctions in the last 6 months, has been that leveraged investor. So it's a gutsy move by the government, given that the New Zealand economy essentially has been one big housing market for the last 6 or 9 months. With the border closed, the economy is still pretty fragile. So we're all waiting with bated breath to find out whether this is going to cause the housing market and possibly the broader economy to come to a sudden stop or not. And there are a couple of people suggesting that a negative OCR is potentially now back on the table, should this turn out to be far more effective than anyone could have dreamed. So it's not a waste of time to think about these things at all. They are mind-bending, negative interest rates, but it's probably actually best thought about as a very, very low interest rate, because that's what it would be for most people. You're not going to be charged to put your money in the bank unless you're a large institutional organisation, and you're not going to be paid to borrow money either. But so essentially you would see lower rates, but not negative rates. There's a couple of reasons that deposit rates would be unlikely to go negative. One is that deposit funding is very important for banks, and particularly in New Zealand, the banks are quite reliant on deposit funding, and making people pay to put their money in the bank is a surefire way to drive those deposits away, possibly into cash under the mattress, essentially, or gold or houses or something else. And secondly, so it's a reputational risk as well for banks. It's not exactly going to be a popular move. So if there's a floor on deposit rates, then that means that there is going to be a floor on lending rates as well. But the gap between the lending rates and the deposit rates does get squeezed the closer you get to zero. And that is one of the risks with negative rates, or even very, very low interest rates, is that lending becomes less profitable for banks because they sit on both sides of the transaction. But if the rates are close to zero, then those net interest margins do get a bit squashed. But there are ways around that. The Reserve Bank of New Zealand has come up with a funding for lending program, which they initially envisaged as something that they would bring in with a negative interest rate as a way of trying to get around some of these risks to credit supply that a negative official cash rate might bring about. But then they realised that they didn't actually have to have a negative official cash rate. They could just bring it in anyway, as a way of basically saying to banks, look, well, the policy that is now that here's $28 billion that you can borrow at the OCR, essentially, which is cheaper than deposit funding or going offshore and raising money in foreign markets, for example. So it's sitting there. Even if banks don't draw down on it, the idea is that it would give banks the confidence to lower their deposit rates and therefore to lower their lending rates further. And the Reserve Bank of New Zealand's still been going on about how they expect banks to lower mortgage rates even as the housing market has gone completely bananas. So it is an issue for monetary policy here, well, for the central bank, that on the one hand, from a monetary policy point of view, the very strong housing market's been enormously helpful for supporting confidence and spending and construction. But from a financial stability point of view, it's becoming a bit iffy because of all the, because the house price to income ratio is so out of whack, for example. And politically, it's become completely untenable. So, of course, traditionally, people who own houses vote in much higher numbers than people who don't, and that has biased the politics. But I think the politics has changed. We have the least affordable housing in the OECD, and we have a homelessness crisis that goes quite a long way up, not just unemployed people and people with mental health problems. We're talking like tradespeople in Tauranga living in their vans, and people who are working 40, 50 hours a week can't afford to rent somewhere to live. So it is pretty serious. But so I'm not convinced we need lower mortgage rates. But this funding for lending program was sort of designed to free up that. But it's a funny one, because the actual surge in mortgage lending that we've seen has not been funded by the funding for lending program, and the fall in mortgages we've seen hasn't come through that either. It's come through the quantitative easing. So the Reserve Bank basically printing money to buy government bonds to push those longer rates down. The side effect of that is a lot of liquidity in the banking system, which turns up in deposits, which is bank funding, which then has gone out the door to fund this housing boom. So the funding for lending program can sort of tinker at the edges of the impact of a negative OCR, but essentially the liquidity in the banking system is also really, really important. And the fact is that QE is kind of tapped out now, insofar as the Reserve Bank is already owning now quite a lot of the bond market, and they don't really want to become a whale in the paddling pool. So they can't repeat that trick of flooding the system with cash again. So if we did see some situation where the Reserve Bank decided they needed to aggressively ease financial conditions, then yes, they can cut the OCR negative. But without that ability to massively increase liquidity again, it's not clear that even with a funding for lending program, that they'd be able to achieve that really strong incentives for banks to lend lots and lots of money that they might have been hoping for. They have actually shot some of their bullets already. So what we were seeing was quite a bit of upward pressure in the pipeline for mortgage rates before this housing move, but now I think we can be reasonably confident that housing lending is going to slow, and so that's going to take some of the pressure off. But I'm not sure a negative OCR would in and of itself necessarily fix that problem anymore. It would be a little bit more of the same, and at some point I think you do end up pushing on a string. I mean, clearly they haven't been pushing on any strings with the housing market. It's been dancing obediently, but business investment's a lot tougher to get going in a recessionary or an uncertain environment. Businesses need a certain level of certainty about the future before they will be willing to invest, and then they consider the interest rate. So a negative OCR, I'm not actually convinced it would be enormously stimulatory. It would just be a little bit more of the same, really. Oops, sorry. Oh, that's my timer telling me I'm out of time. So I don't want to derail. We've got a lot to get through, so I'll leave it there. But we do have Q&A at the end of the session, and I'm happy to take any questions at that point. Thanks, Ian.
Thank you very much, Sharon. I think I might go now to Tice at this point. We've heard about the macroeconomic effects. What do you see as the position for an investor or a bank in this environment?
Yes, thanks, Ian. Let me quickly, in 2 sentences, explain what we are doing at APG. We manage a very large 500 billion euros investment portfolio for about a third of the Dutch populations. They have their pension savings with us. So we invest that on their behalf, but we also make use extensively of derivatives to manage the portfolio. We hedge the liability risk using long-dated interest rate swaps, and we use a lot of FX forwards to take out currency risks. That implies that we also see, because these positions are all very much directional, that we're very active in money markets, hence an immediate impact with negative rates as soon as they hit the European bloc. And to tell you a bit about our experience, let me look at that from 2 angles. We've had the investment part. Sharon already spoke a bit about that. I have some additional comments on that, but there's a more technical part to it as well. And the first thing is, can your systems actually deal with negative rates? Because it's not immediately obvious that all your systems are prepared in each and every field that you can enter, that you can actually do negative rates and accommodate that. After you've done that, some of the experiences we had is that there's more changes when you move to negative rates. So late payment actually is not that worrisome anymore unless you need to pay the money. But from an interest rate perspective, a late payment is actually is an advantage because you lose money when you need to put it out in the money market. That also implies that if somebody pays early, they're actually forcing a cost onto you. And that's something that you should be aware of, especially because the introduction of negative rates in Europe came together with a lot of new banking regulations. So at quarter end, first it started at year end, then it became more pronounced at quarter ends as well, but at month end as well. Banks want to have their balance sheet look nice. And then when you come with the last minute collateral position, cash position that you need to put out in the money market, nobody is willing to take it. At year end, I've paid, I think, rates up to -10, -15%. Of course, it's just for one day. So the amount is not staggering, but if you translate that into an annual rate, you actually do see -15% that you're paying if you want a bank to hold your cash over year end. So if then somebody at that moment in time decides, well, I'm going to pay these guys their money back a little bit early, and you get that money back just before year end, you better be careful, because that is something you want to send a claim to your counterparty that was not what was agreed. Then I think by now, but just double check if all of the people in the audience actually signed up to the ISTA negative rate protocol. Because if you deal in derivatives, that takes care of all the bulk of the technicalities of the contracts that you need to deal with, and otherwise it's individual negotiations. These individual negotiations can be nasty, because on the one hand, I get collateral in cash from my bank. I need to put that out in the money market. I do a transaction with that same bank. They're happy to pay me a negative rate, or actually give me less money back than that I give to them. But then suddenly on the derivatives documentation, they would argue, yes, but the contract states that you actually pay an amount or an interest rate over the collateral being posted, and paying implies that you can't be receiving, and therefore the cycle doesn't work. So you end up with doing business with them in the money market, where they're happy to take your money at a negative rate, but refusing to pay on the derivatives part if you did not take care of that properly by agreeing upfront you would adhere to the negative interest rate protocol. So that's also something you need to be careful about. And there was one bank that actually was paying negative rates on the collateral they posted, or they posted with us, so we paid them negative rates. And then suddenly, apparently, we did not, because dealing all of this with 30 different banks might be cumbersome, especially for smaller institutions. So apparently, we did not finalize all the legal documentation with them properly, and therefore they reverted on their position of actually being paid negative rates. So they stopped doing that, and then you end up in a nasty negotiation. I ultimately resorted to not taking their collateral, because I argued, well, we do have enough counterparty exposure, or we can accommodate this counterparty exposure to you. It was not a really large position. If you post collateral with us, and you're not accepting negative rates, then I'm losing it on the money market side. So I'm not taking your collateral. That threw their systems a bit off guard because it suddenly popped up constantly as a short-term liability on their end. And so ultimately we were able to remediate this, but that took a couple of months to actually get that all settled. So that's very much the technical part. Of course, then the question is, what does it do to your investment portfolio? And I think this is something we can all see. The big search for yield is very much driven by these low rates. If your cash is yielding negatively, you want to invest it. So you move from cash to short-term government bonds, cash equivalent things, but soon they are yielding negative results as well. So you get pushed farther out on the on the risk curve continuously, whereas at this moment in time, I think we're not compensated properly for the risk that you're taking. If I'm giving somebody money for 30 years, even if it's the German government, I expect to be paid for that, and I'm not expecting to actually get less in return, because then for sure I'm losing money on it. And then philosophically, or maybe maybe even anecdotally, does this really create the behavior that you would like to see, that people go out and spend and that companies invest wisely? Well, ultimately, but that's something that Sharon also alluded on, I feel that that's not the case. I think it's distorting financial markets because there's not proper risk premiums anymore being paid on risks that investors are taking. So looking at my home country in the Netherlands, I feel that if rates would move up to 5%, a lot of people, if they kept their mortgage short and rates would go up again, I'm doubting if they would actually be able to pay that mortgage. So that's definitely a risk. I see people worrying about their pensions because the expected returns are a lot lower based on this low rate environment and the compressed risk premia. So actually people start to save more instead of spending more. So there's all kind of effects that I think central bankers are not paying enough attention to, thinking about these low rates. So we'll see in 10, 20 years down the road if what everybody thought, that when Mario Draghi said whatever it takes and rates were taken negatively in Europe, if that was actually a good thing. I actually doubt if that was a good thing. So apart from the technical stuff, there's also all kinds of aspects that you need to think of when you're managing an investment portfolio. And bottom line, our capital markets should allocate capital efficiently and not keep it tied up in zombie banks, zombie countries, or zombie companies that actually should go bankrupt, but because they can finance themselves at zero or close to zero, they're able to stay afloat. So we're doing away with the efficient allocation of capital, and that is something that worries me. And with that positive outlook, I think it's time to end my little speech.
Thanks very much, Thijs. I think that worries us all. But let's try to bring a legal perspective to it now. Easy to say the word negative rates, not so much fun trying to document them. I wonder if I could turn at this point to Peter to give us your thoughts on what does this weird world mean for loan and deposit documentation?
Thanks, Ian. Yeah, it's interesting hearing the comments from Sharon and Tees. Quite encouraged by Sharon's view that we're not going to get negative rates. I feel quite encouraged by that. But anyway, notwithstanding that outlook, that optimistic outlook, we do need to be prepared from a legal and documentation perspective. I thought what I'd do actually was just, like all good lawyers, we go searching for the precedents in the case law and thinking about what would happen. There has been one case, well, there's been three cases we found in our research which deal with negative interest rates. The most useful one actually was State of Netherlands and Deutsche Bank, which was a UK Court of Appeal case in 2019, which actually turned on the interpretation of an ISDA credit support annex. It was a one-way arrangement with Deutsche Bank being the only party that was providing collateral in that case. And the question which came up was whether the amount of the collateral that was required to be repaid at the termination should be reduced by the effect of negative interest rates, which were applicable at the time. Deutsche, not unsurprisingly, argued that they should get all their collateral back, dollar for dollar. The State of Netherlands argued the opposite and said that the amount which Deutsche were entitled back was to be reduced by negative interest rates. The Court of Appeal ultimately decided in favour of Deutsche Bank and said that they were entitled to all their money back. The decision turned on essentially an interpretation of the CSA at the time, and you will have heard Tees mentioned that obviously ISDA has subsequently in 2014 brought out a negative rates protocol, which we understand that many market participants have adhered to. This particular CSA in this case was entered into prior to that and prior to even ISDA guidance notes, which recommended that parties needed to revisit their CSAs and documentation to address negative interest rates. So it is a contractual, it was a case which turns on contractual interpretation, but it's an interesting one in the context of thinking about how would a court in New Zealand or Australia look at the question of whether or not negative interest rates should reduce either the amount payable on a deposit or the amount payable on a loan if it ever came to that. Just mention in passing, there's a couple of other decisions from other jurisdictions. There was a Swiss decision along the same lines, which actually reached the same conclusion as the Deutsche Bank case, but there was also a Dutch tribunal decision on a different set of facts, which came to a slightly different conclusion and decided that you could have the amount of collateral reduced by negative interest rates. So in New Zealand and Australia, obviously, this is going to come down to a question of, what does the contract say, and what is can you imply a term into the contract that the amount payable in either on a deposit or on a loan will be reduced by negative interest rates, and that will probably turn on a question of whether or not that is an implied term of the contract. And obviously there's quite a bit of law around as to the circumstance to contractual interpretation and the circumstances in which you can imply terms which are not specifically dealt with in the wording of the contract. And there is a case in New Zealand, which is Bathurst Resources and Element Mining, which is going to the Supreme Court shortly on appeal, which hopefully will provide some clarification, at least in New Zealand, on the distinction between the sort of overlapping tests regarding implication of terms and interpretation which currently exist at the moment. Against that background, I thought just touch briefly on, moving on to, what would happen if we did get into the circumstance where we're faced with negative interest rates, and what does it mean for deposits and for loans? For deposits, obviously, there's no obligation to pay interest on a deposit, and ultimately it comes down to a question of contract law and what are the terms and conditions which apply to the deposit and the relationship between the bank and its customer. So if you've got a fixed rate term deposit, clearly the rate's fixed up front, everyone knows what it is. If the OCR drops halfway through, that's not going to change the rate which the customer gets on its deposit. If you've got sort of floating rate deposits, then once again, you're going to need to look to the contract. Mostly for deposits, those will probably be the bank's general terms and conditions rather than any specific agreement. In our experience, general terms and conditions don't deal specifically with negative interest rates. They will normally always say things like that, the bank will pay the depositor interest on the deposit. And following the logic from the Deutsche and State of Netherlands case, that would tend to indicate that that negative interest rates shouldn't apply to reduce the amount of the deposit. If the terms of your documentation use a slightly more passive tone and use terms like interest will be paid or interest accruing will be paid at periodic intervals without specifying who's paying and who's receiving, then maybe there's an argument that you could interpret that contract as one which implies that negative interest rates could reduce the amount of the deposit. But even with the trend towards plain English general terms and conditions, which most banks are adopting, we don't tend to see that sort of wording. So in those circumstances, if you're going to deal with negative interest rates in your documentation, you're probably going to need to amend your general terms and conditions and include some mechanics that specifically contemplate negative interest rates, and probably also think just some basic mechanics like giving the bank the ability to deduct the amount of negative interest from the principal of the deposit or from other customers' accounts if the customer decides to whip the deposit out before he pays the negative interest rate. A couple of other points to think about in terms of deposits and investment products. Obviously, in New Zealand, it's the Financial Markets Conduct Act. Compliance issues, will the banks need to revisit their product disclosure or any other deposit taker need to revisit their product disclosure statements for any regulated offers, making sure they're making appropriate disclosures in relation to all their investment products. Also, the fair dealing provisions, the FMCA as well, will obviously prevent misleading and deceptive conduct. So, if you sell a customer a deposit and tell them that it's going to be a great return and provide a certain rate of interest, and then that's subsequently changed so that the customer loses some of their principal amount, then that's potentially could, in the worst case scenario, be misleading and deceptive conduct. So the banks will need to focus on what their frontline staff are telling their customers. In relation to loans, same point, obviously, you need to look at the contract. In the institutional markets, certainly in New Zealand and Australia, the issue has been addressed by the inclusion of zero floors. The Reserve Bank in New Zealand has made it quite clear they don't like the idea of zero floors and would like to see them removed. And that then leads to a number of questions. Firstly, well, how do you remove them? You could do it unilaterally and just effectively waive that provision in favour of the borrower. But there has been some advice given to some banks in the New Zealand market that a waiver might present a tax risk. So the preference would probably be to amend rather than waive, and then one gets into discussion about what you need to do to have an effective amendment of the facility agreement. Can you still impose a lower floor below zero, which means that you're not sort of actually paying money away? You have sort of an absolute zero rate. Possibly, not sure about that one. Interestingly, also tax comes into it again. The New Zealand IRD, I gather, has expressed a view that as a general proposition, negative interest is not seen as quotes interest or payment in respect of money lent in terms of the definition of interest in the New Zealand tax legislation. So there shouldn't be, therefore, any issues of resident or non-resident withholding tax if you end up having negative interest rates being paid to borrowers on loans. But obviously, there's kind of a number of things which you need to work through. And in the lending context as well, obviously, we need to think about, if it's a consumer credit contract, God forbid we ever had negative rates on consumer credit contracts, but, there's disclosure obligations in relation to those types of arrangements as well. Another interesting question is whether in an institutional type loan agreement, if you didn't have a zero floor, what protections might you have? And there's some discussion about whether or not that would trigger a increased costs or market disruption clause, which are margin protection clauses for the bank. Possibly questionable whether you trigger an increased cost clause, because that normally has to be a change in law. Although whether the direction from the Reserve Bank to remove zero floors constitutes change in law is another question. Probably it would trigger a market disruption provision. The wording around those obviously is normally as a result of a market circumstance, which is not limited to the individual bank. The cost of funding its participation in the loan is greater than the base rate. So if the base rate, in this case BKBM or BBSY, was less than zero, then clearly your cost of funding is going to be higher than that. That probably would trigger that market disruption provision. And the question would be whether any banks would be willing to use that to protect their margin. So there's lots of questions. The interesting part, I guess, once you start getting into some of these questions and working out what the answers might be, is to work out how you implement the solutions. It's obviously a very big job for banks to make changes to all of their documentation across all of their product suites. And so it will be a case of each bank analysing what the risk is for each particular product suite, analysing its documentation, and then working out what the most efficient way of making those changes to the documentation is, and whether indeed you can make those changes by unilateral notice to the customer or whether it requires negotiation with each customer. I could probably talk for a bit longer, but on that I will stop and hand back to Ian. And obviously if anyone has any questions after, I'm happy to answer them.
Thank you very much, Peter. Certainly there's a large number of questions to be explored in deposit and lending documentation. But if I might turn to David, for the financial markets more broadly, what implementation measures or preparation measures are you seeing at AFMA, or what else should we be thinking about in capital markets and derivative markets?
Thanks very much, Ian, and it's been certainly very interesting listening to all the other panelists come up with the issues which in one way or another have been discussed here at AFMA and from an Australian perspective over the last several years. We really, in Australia, I think were far more focused on this issue back in 2019 in a preparatory sense. There was a lot of looking over what was happening in Europe, particularly with jurisdictions like Denmark, introducing negative rates and the implications there. We raised, of course, sought out and put out feelers to find out practical experience from comparable industry associations over there in Europe to get a sense of the sorts of things that they had to deal with in a practical sense. So through our committee system here, we then certainly opened up a number of channels of discussion there, as well as with the regulatory authorities. So in a sense, that preparatory need to sort of think about what was happening, I think we were ahead of the curve with ahead of our authorities at the time about thinking about these things. But certainly soon afterwards, we got questions from the ASIC and the RBA in particular about what we'd been doing, what we'd been thinking about. In many ways, from the sort of overall industry sort of perspective, the issues was about finding out what the banks thought they needed to do. I think everyone was looking at operational issues at the time, looking at system capabilities, and I think Tees mentioned these in his presentation as well, that you had to have the processes through the trade life cycle, how to do valuations, how to handle sort of accounting and other issues in the system. Generally, the reporting we came back with was that the systems actually had a lot of capacity to deal with negative interest rates as such. The more interesting question, which really came up, was about how to deal with zero. Zero turned out to be the biggest problem. in the system rather than sort of negative, where you could the systems actually could sort of handle a negative calculation as such and produce an outcome. There were, of course, as Peter's sort of gone through, there are a lot of issues about how you then deal with your client base and the practical issues associated with documentation, especially lending documentation. But from the security sort of markets point of view, the issues were really, in some sense, more straightforward, I think. For us, the most practical thing was AFMA maintains OTC market conventions in place. And our credit sort of conventions had to have a bit of a look at in this context. And through late 2019, we looked at the formulas, particularly to deal with FRNs and with zero coupon and zero benchmark floors. So I think there was a sense of preparations was not to go to negative, but to prepare for the situation where you might go be at zero. When we did a review of the various methodologies and the calculations that we had in our documentation, we found out mathematically that yes, they could cope with a negative interest rate there. But there were difficulties certainly if you had a zero coupon or a zero benchmark in your calculation there. So we approved, there were amendments approved to our credit product conventions in early 2020 to account for the securities, which had a zero coupon floor in place in the event that the rates were to fall below zero. As many things occur when the quants started having a look at these sort of things and the changes that were coming through, it came out then that there were issues, not with the negative side of things, but where you had actually a zero in there, not being able to divide anything by zero. That caused more complications there. And so there was basically the calculations were dealt with by simply excluding zero as a possibility from that, and saying that standard market calculations were not designed to deal with that situation. We then, more recently, there have been more discussions too about where you have, you're trying to deal with the swap, and on one leg of the swap is negative and the other is positive, and there again we found that there were some discussions about whether or not the math actually worked out. There's been, and more recently, there's actually been amendments worked on to deal with that situation in a real time. So that, from a sort of market-wide perspective, it's making sure that your formulas actually all work is of importance and practical need. The next part of the issues that have been faced in a practical sense have come from Australia not having a negative interest rate, and we'll come to, as Sharon said, the chances of a negative rate here are to continue to be low, and not to use a pun on the governor's name there, but he's been very clear that he expects those to be very unlikely in the Australian circumstances. And the only reason really why Australian rates are so low now has been external pressure from other major jurisdictions, so that there is no capital flight or no arbitrage opportunities and the carry trades opportunities there, which would push up the Australian dollar to extraordinary heights. Which is always a big practical consideration from a macroeconomic perspective for Australia, given the amount of capital we borrow offshore and the importation of that. But coming back down to a domestic and very practical level, the need to deal with aspects of having a 10 basis points interest rate, so just above zero here at the moment, had consequences with things like doing haircuts, margin calculations, and other things, where you find suddenly that anything based off the RBA cash rate, Ionia a rate there, would have you'd be in negative territory with regard to sort of margins or haircuts that might be within things. In those circumstances, of course, once again, there was a need for the parties to come together, decide what to do. In a number of cases that it was agreed not to put a zero floor on those as a practical matter. That aspect, and again, it's been touched on a couple of times, is that all these things have tax implications within the system. And again, even at the very low rates that they are, even though our housing market certainly has picked up, we're nowhere near the situation of New Zealand at the moment, but we've seen prices rise, but that's because of limited supply. And in fact, the ability of the banks to pump out mortgage loans is limited by simple practicalities, that there's just not enough property for people to go out and spend money on at the moment, more than anything else. So to us, the real issues here in these times has been sort of less of a focus on, I would say, over the last sort of half year, basically. It's more to looking at the impact of a very changed situation where we actually have to deal with the Reserve Bank here, taking measures to depress the speculation out on the curve, out on the 3 and 4 year, where it's sending a message that it wants to keep rates at a very low but positive level over the next 3 or so years at a minimum, while the market has been pricing in certainly higher rates on the forward yield curve. So that's resulted in restrictions on availability of certain lines of government stock for the repo market and other things in order to send messages through to the market and to kind of use different instruments to affect monetary policy and provide price signals into the marketplace. So overall, it's there are probably some different dynamics now developing in the market beyond just trying to deal technically with negative interest rates. But I might leave my comments there and let us get on with further discussion.
Thank you very much, David. We have a few minutes now, maybe 10, for some Q&A. And I'm just looking, we have 129 participants at the moment. I'm looking to see how many questions that we have on our board, and it's not showing us any at the moment. So please do put in your questions if there's any you have. But I might start off with a question just to get it going in the meantime, which is probably a question for Sharon and then Tice. And that question is this: whenever I see the discussion of negative rates, it's there in the New Zealand Chief Executive's letter, and it would be also true on this side of the Tasman for regulatory reasons, and that is, don't apply it to retail. You wouldn't do it, not just as a matter of policy, but one would probably struggle for a deposit product with a negative rate to still be a basic deposit product, and that then would trigger a whole pile of legal obligations, which would be utterly impractical. But if you take that as your policy and you don't apply it to retail money, you only apply it in wholesale markets, my first question is, do you actually, the economists get the bang for their buck if it's only applying to wholesale money? And then secondly, if that's what it's done to, does the money go to the right place?
Well, everyone's idea of what the right place is different, of course. But you're quite right. That effective floor on deposit rates does put a floor on bank funding costs, which then puts a floor on mortgage rates. So the funding for lending program the Reserve Bank has introduced is designed to get around that. But I suspect it might run into the same constraints that it has already now without a negative OCR. And that is, while it's 28 billion, which is enormous in terms of new mortgage lending. It hasn't been drawn down much, but it's sitting there. It's big in terms of the new lending, but what you have to bear in mind is that we have a steamroller of existing lending coming through that needs to be funded on an ongoing basis. When we give someone a mortgage for 30 years, we don't fund it for 30 years, we fund it for maybe 5. And so you've got this stock rolling over the whole time. So in terms of banks' annual funding needs, 28 billion is a drop in the bucket. And so it's not actually as powerful as it looks in terms of lowering banks' cost of funds and therefore freeing up the headroom to lower those interest rates. So that's another reason why I'm not convinced cutting the official cash rate from here would necessarily provide a whole lot more downside for retail rates. And that's quite apart from the question that Tace was raising about whether you really want lower retail interest rates, whether they're potentially doing more structural harm than cyclical good, which I personally think at some point you've got to take your medicine or rather than storing up all your problems for somewhere down the track. But that's a separate issue. The Reserve Bank is mostly concerned about getting that passed through. And our experience with the funding for lending programs so far is that it really is tinkering at the edges. It doesn't actually really solve that problem, that you could have an accidental negative impact on credit availability potentially.
Thank you, Sharon. Tace, did you want to comment on that?
Yes, because of course we've seen this happening in Europe, and there's indeed a reluctance to pass on these negative interest rates to retail clients, and actually you don't see it happening, but that doesn't imply that they're not paying for it. So if you put money in your savings account, you indeed will get a 0 rate. But banks, on the other hand, need to do something with this money, and then if it's still short, the opportunity, what they can do with it is relatively little. So if they just need to put it ahead, take the simple equation, they take your money, don't have something to do with it at this moment in time, put it in the money market, there's the negative rate. So then they're losing money. So the margins are being squeezed. And since banks somehow do need to make money ultimately, they're going to try to make it somewhere else. That's why I see that in the Netherlands, mortgage rates are still relatively high, because the higher spread on these mortgage rates is compensating the banks for, on the other hand, not passing on the negative rates on your savings account. So you're paying a little bit too much on your mortgage, but therefore in return you're not getting negative rates on your savings account, but ultimately you're still paying for it. And this mortgage market, as an example, is something that is not that easy to enter into. You see that happening. It's something we're contemplating as well, because we see these interesting mortgage rates, which is relatively well collateralized loans, that we think, oh, that's an attractive yield that we can make. So why do not provide funding and be active in that market ourselves as well, instead of leaving that to the banks, which is the usual outlet. So slowly that benefit that banks have created there for themselves will get eaten out, but that's not something that will happen overnight. So do not think that because it's not passed on to you as a retail consumer that you're ultimately not paying for it.
Thank you. Tace, I might stay with you because a question has just come in relation to negative rates and their effect on pension funds in Holland. Which asset classes fared well and not so well?
Well, it's amazing the answer that I'm going to give, because that if you asked me that for 10 years ago, I wouldn't have answered that would be the best performing asset. But a 30-year bond or a 30-year swap with rates going to 0, where you were still at 3% 10 years ago, actually was a fabulous investment. It did better probably than most of the equity markets. But to be honest, getting 2% on a 30-year bond wasn't that attractive for me several years ago. But I was mistaken. So it proves that markets can be, in my view, wrong for a longer period than you can stay solvent. Then the question on how does it affect the overall performance? Well, funding ratio, since we need to discount with the European swap curve our liabilities, actually look terrible in the Netherlands. So solvency ratios are around or even below 100%. So people are actually afraid and think that there's not enough money to pay for their pension. Whereas if you make a calculation on the return that we need to make to pay all the pensions, that number is relatively low as well. So I think with just 1% of return for the next 30 years, we're able to pay all the obligations that would exist, even though the solvency ratio is only at 100%. But you're more or less discounting with zero. So even a payment that I need to make 50 years down the road to pay somebody's pension, I have to have fully funded on my balance sheet at this moment in time, which is also something silly.
Thank you. So just picking up on that, I'm just there's a very basic question I'm a bit curious about. What does the yield curve in those actually look like in those jurisdictions with a negative environment? I would think, say, as a banking lawyer, a bank should always pay for tenor. NSFR will force it to do that, APS 210 in this country. So is it the case that you see less negative rates as the duration
think
goes
about your toothpaste, and you're just squeezing it out. That's what's happening to the swap curves that we see. It's going up a bit, but even 30 years has been negative in Europe. It's also a supply and demand thing, because there's apparently more demand for hedging activities. So I wouldn't infer that that's what everybody is expecting to be a fair compensation or an estimate of productivity. That's what economists usually do. They take the market and then say, oh, the market is expecting this amount of economic growth. I'm not so sure with mandatory type of hedging going on, if you're tampering with supply and demand in that sense, if you can really make that conclusion based on what's going on in the market. But I think 30 years is now back up to 40 basis points, something like that.
Thank you. I think there's just time for one last question, which has come in for Peter. Don't know whether you can see that one, Peter, but it's just about whether people are changing loan documents now or waiting around for the next update.
Sorry, I can't see the question, but I can answer it. We are aware that banks are looking closely at changing documents now. Some banks have been going through their product suites and preparing to go live with changes. In terms of just the institutional or the wholesale markets, notwithstanding the Reserve Bank's letter to the bank CEOs, we haven't seen a sort of a rush to the door in terms of removing zero floors from loan agreements. Most people are quite resistant to that, people are aware of it, but are kind of holding on for as long as they can, I think.
Thank you. David, did you want to comment quickly on that in terms of moves that people are actually making?
Well, yeah, I'd certainly agree with the view that people are very reluctant in documentation to go negative, and generally what we see is having a zero floor or zero coupon in documentation to avoid a lot of the practical problems that applies across the board. So I'd agree very much with what Peter's just said.
Okay, Well, I'm just conscious of the time and the need for these for people to get back to their busy schedules. Absent, I'm sure if people do have questions afterwards, I'd like to ask any of us that can be put through the association. Could I ask everybody virtually to thank our panelists, Sharon, Tys, David and Peter today, and with that I'd wish everybody a very good afternoon.